Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV, where we bring you exclusive interviews on some of the market-moving events shaping APAC trade. This week I'm reporting from Melbourne and spoke to Julie Toth, Chief Economist at the AI Group, to catch up on some of the manufacturing, services and that GDP number. Julie, many thanks for taking the time to chat with Dukascopy TV once again. It's a pleasure to receive you.
Thanks, Natalie.
No problem. Now let's start with the GDP estimates. As we've said, a big focus, lots of notes, lots of reports this week. Now it did miss estimates and we saw a steep fall in the Australian dollar. Well, we can't attribute this fully to those growth concerns out of China. Is this perhaps a sign of things to come for the Australian economy?
Well, there's quite a few things going on in the bag of GDP data that we got this week for Q2 2015. Bearing in mind that it's now a couple of months old, it is signalling that there's quite a few trends going on in the Australian economy that are not good news. It's possible, though, that might be the worst that it gets for a variety of reasons. Looking at the reasons for the fall in growth rates, and it was in the nominal GDP growth as well as real, so real growth fell, but the nominal rate fell largely for inflation reasons, commodity price reasons, similar story to what we're seeing elsewhere around the world. The real GDP growth story, though, is very much a local one, and as you say, it is partly due to what's happening in China. So the fall in demand that we're seeing for commodities globally does, of course, affect Australia directly through the terms of trade. That's the pricing effect, and we have seen another big step down in the terms of trade for Australia. We also took a hit on export volumes in this quarter. So it's possible there were weather-related reasons for that. It's possible there were a few short-term impacts going on that volume side, but certainly the China story is the big one for commodities, both pricing and volume. The other side of it, of course, is that in the commodities space, we have had in Australia a record investment boom in mining and resources. That's very well documented, and I'm sure most of your viewers would be aware of it already. The peak for that is actually a couple of years ago now, 2012, 2013, were the peak years for that investment in iron ore, in LNG, in the rail and other infrastructure that goes with that. So, to put that into perspective, engineering construction investment fell another 20% in the year to Q2, and that also contributed to this very weak number. So both of those things have contributed to growth over the last couple of years, and now that they're coming off the boil, we're seeing them detract from growth to the same extent. More recently, and not connected to those cycles at all, Australia's population growth rate has fallen significantly. It was around 1.7, 1.8% per annum just 2 years ago, quite strong by advanced economy standards. We're now down to a documented level of 1.4% last year and an estimated level of 1.2% this year, so quite big falls in our estimated population growth rate, and that's also feeding into these numbers. Even so, GDP and incomes per capita have fallen, so in real terms Australia is worse off at the moment.
You touched there on mining. The RBA did in fact discuss those falling commodity prices and the impact that they're having on the Australian dollar, noting that the local currency is adjusting to those significant falls. Let's touch on the Aussie dollar for a moment. We've seen it go to 70 US cents off the back of that GDP figure. Do you see the local currency putting the brakes on now, or could we see moves even further to the downside?
That's a really good question, because the Aussie dollar has traditionally tracked quite closely to commodity pricing, and given that the consensus is that most of our key commodity prices, particularly iron ore, coal, oil and gas, those pricing trends are heading further downwards globally. they will take the Aussie dollar down with them. The dollar actually fell below 70 cents this morning for the first time in several years, and it could fall further. We also have the cash rate differential, which doesn't look like it's changing anytime soon. So taking that out of the equation, the commodity price track does look like it could pull the dollar lower. The Australian dollar is famous for being our automatic stabiliser. It does a lot of the heavy lifting in our economy, and it really looks like that will probably happen again. We're already seeing the benefits of that in other sectors, not for the miners and their profits, of course, but certainly for other sectors, other exporters, the import replacement areas. We are already seeing a small lift, small, promising, very, very welcome indeed for many sectors outside mining. So we do hope that will continue.
Well, absolutely. We've seen gains in this week's manufacturing and services indexes from the AI group. How then is the Australian dollar, helping to push those upwards, as you say?
That's an interesting question, because the dollar's been low for some time, but it's probably only the last 3 to 4 months that we've seen the direct impact of that in data that we can track. So the performance of manufacturing index, that's been positive for 2 months now. We're seeing an actual expansion in manufacturing activity. For the much bigger services part of the economy, that's been positive for the last 3 months. In both cases, the benefits of the lower dollar can be seen in exports, particularly in the manufacturing area. We're seeing that in food and beverages exports, pharmaceuticals, toiletries, cosmetics, that type of group. A smaller increase in specialist machinery and equipment. On the services side, we're seeing that mainly in the population numbers actually. As I mentioned before, the overall population growth rate is falling. That's for permanent residents. However, our temporary movements are changing. So we are seeing a tailing off in what could be described as a net tourism deficit. For quite a long time now, Australia's had far more people leaving for holidays than arriving. That's starting to turn around in that the departures are levelling off. They peaked a little while ago, and the arrivals are increasing. So we are seeing the benefits of that for local services, particularly the obvious ones like retail, accommodation, tourism, entertainment spending.
I can't understand why anyone would want to leave Australia. Julie, many thanks for the update.
You're welcome, thank you.
Great comments, as always, from Julie Toth at the AI Group. That's all we've got time for right now. Do stay tuned, as I'll be bringing you more exclusive interviews from when Sydney Direct went to Melbourne. For now, though, it's goodbye.